That's the last time interest rates were at what number? 0.
Welcome to the Freedom Point Real Estate Podcast, where we talk about creating more time freedom through passive real estate investing. Passive investing in real estate challenges conventional investment wisdom. We are passionate about learning and sharing resources with others who are ready to transform their investing mindset. Quick disclaimer as always, I am not a CPA, I am not an attorney or a financial advisor. This is not financial advice, not telling you or anyone else what to do. The views and opinions expressed in these podcasts are provided for education and informational purposes only and are not necessarily the views of my employer. I'm glad you're here. Now let's dig in. All right, welcome back, Freedom Point Podcast listeners. Thank you again for jumping into yet another episode of the Freedom Point. We're so glad you're here with us again today. I've got another amazing guest as always, and I've got the Michael Guthrie. Michael, welcome to the show.
Hey, thank you so much, Jeremy, for having me on. I appreciate it.
Yeah, absolutely. I'm really looking forward to chopping it up with you. For my listening audience, Michael is the founder and managing partner at Pacific Capital, a real estate investment firm with $500 million in assets. Previously, Michael owned a nationwide ATM distributorship with over 8,000 ATM machines, successfully operating that business for 28 years. I'm not doing your bio much justice here, Michael. So maybe you can let our listening audience know a little bit more about yourself, your journey, what you're focused on today, et cetera.
So thank you so much for that, Jeremy. In the ATM space, we started out with one. We bought one, we placed it. Then we bought our second and placed it. And then all of a sudden we were starting to run out of our own money because we had to load our own machines. So that's how that got started. But then I started selling them to mom and pop convenience stores, gas stations, truck stops. And you just start to create relationships one at a time, over and over and over again. And as we started to grow, I couldn't do it all. So we started to bring on affiliates or distributors, if you want to call them that. And they would run their route, but then they'd process their transactions through us, which helped us with our growth, helped us negotiate better buy rates with the processors and that sort of thing. But the main thing I learned through operating that business for 28 and a half years is you have to create relationships one at a time, and you have to do what you say you're going to do, even when nobody's listening. Your integrity in this business is everything, as it is in real estate. You do what you say you're going to do, and you always continue to follow through and follow up with everybody, just so then they know you care as much about them as they care about you.
Yeah, and I would probably venture to say that was really the cornerstone of your success, going from 0 to 8,000, ATM machines is really, eating the elephant, one bite at a time, one relationship at a time. And really that was made possible as a direct result of you, showing up, providing value and really following through on your commitments.
That is absolutely correct. And you couldn't have said it better. You always have to be there. When somebody calls, you have to answer the phone. When somebody emails, you have to respond. So if you're not going to respond to folks, the sales side of any business isn't for you. Maybe there's another avenue for you to go, but people expect you to be there when they are there.
Yeah, so it's fascinating, the space that you came out of. And I know that that's no longer a focus for Michael Guthrie, but I would love for you to share a little bit more with our listeners as to some of the benefits, that investors in the ATM machine industry are really looking for. I would presume that given the fees that, are charged, at the time of withdrawal, are a significant, source of cash flow for those investors. But I ought to also think that there's some, tax benefits as well that are probably on an accelerated basis. Am I saying these things correctly?
You are. I'm going to make one correction. We never had any investors. We did this ourselves. So anytime we wanted a tax benefit, we got the tax benefit every time we purchased an ATM, because you could actually depreciate it in year one. It was a couple $1,000 piece of equipment. So it was, I think it was a section 179. You could write the whole thing off in year one. So you don't have to carry it. It's more like an expense, is the way it sort of looked like, the way I looked at it. The IRS looked at it as a depreciable asset, but you could depreciate it all in 1 year. So there is the depreciation aspect of it that is similar to apartment buildings, where you get a major tax benefit just by getting into the game. So I think that's where you wanted me to go with that.
Yeah, no, I appreciate you clarifying that. So I think about like an ATM machine. It's really a piece of technology in some respects, and a machine, in another, right? So I can only imagine, that as technologies change over time, as equipment breaks down, that therein lies why the IRS allows you to really accelerate that depreciation loss activity on that ATM machine in the first year. Because in truth, my guess is after about 5 or 7 years, those ATM machines are almost worthless at that point. Am I saying that right?
You're saying it correctly. I would say that out of the gate, the ATMs way long time ago lasted a lot longer than 5 years, even though they had a 5-year depreciation schedule per the IRS if you wanted to spread it out over time. But today's ATMs they're more likely to break in the first 3 to 4 years. So then the 5-year time frame of owning and operating, you need to replace and recycle. And the networks have over the last 10 or 12 years have adjusted their network regulations for security, and they say it's all in the best interest of the card holder. I think they add those additional expenses onto the business, so the barrier of entry becomes higher and higher for folks. So then they can't just get in for a $2,000 piece of equipment. Now they're in for a $4,000 or $5,000 piece of equipment these days with the additional technology in the name of security for the card holder.
Yeah, that makes total sense. And I'm going to get off of my ATM soapbox here for a minute and make a transition. I'd like to talk about your transition from ATMs to real estate, and really, can you share with our listening audience what inspired you to transition from running a nationwide ATM machine distributorship to launching Pacific Capital?
Absolutely. So we were making so much money, we started to buy single family homes for depreciation benefits. So we got up to, I think, 8 single family homes, and that became unmanageable. And then we learned more about the bigger buildings and bonus depreciation. So in 2020, my wife and I attended a conference in Dallas. It was virtual. I think we were in the middle of COVID then. So I think, if I'm remembering correctly, it was virtual. And got introduced to buying big apartment buildings for tax benefits. And all of a sudden, we shifted gears. Instead of putting more money into single family, we went into buying multifamily as limited partners. I got into this business just to be a limited partner. I never wanted another job. I just wanted the benefits of the investment. So we actually took me off of payroll in 2020 on the ATM company. I became a real estate professional. So then all my depreciable loss would offset my wife's active income. So since 2020, I've not paid federal income tax legitimately, legally, and truthfully. So we have used our capital that we've had to invest as limited partners in a number of deals. That's not even part of the 500 million. That's on top of that 500 million. The 500 million is as general partners, but the rest of it we put in as limited partners, just so we wouldn't have to pay taxes. And people say don't invest in a deal just to not pay taxes. Well, we were paying almost $1 million a year in taxes. So for us, it was like getting another job just by investing.
Yeah, it's interesting that you say that. And obviously, I want to throw a little disclaimer that neither Michael nor I are CPAs or tax specialists. So just want to throw that out there. But my wife and I use the same strategy. My wife did not have, at the time that we started investing as LPs, did not have a working W-2 or 1099 job or income. And so we were able to make it so that she spent at least the required 750 hours per year on real estate related activities. Of course, my business, Starting Point Capital, is a private equity real estate entity itself. And so we were also able to check that box. And if you're able to become a real estate professional, either yourself or a spouse, it's incredible. Okay. I personally went from the 37.5% federal tax bracket down to 12. So that means every time I deployed $100,000 into a new deal, day one, I was benefiting as a direct result of deploying that capital. And that does not even include the fact that there's the cash on cash returns, there's the equity, upside at the end. I was merely benefiting as a direct result of those passive losses that we were able to then use to offset ordinary income. Does that make sense?
That makes a ton of that's exactly the reason we did it, and is exactly how we did it.
I'm Zach Captainstall, CEO and co-founder of Rise 48 Equity. Our goal is to help you protect and grow your wealth by investing in large multifamily apartment buildings. We do all the work as far as sourcing these large apartment buildings from the brokers, doing all of the on-site management with our vertically integrated property management company, doing all the renovations with our vertically integrated construction company. We completely rebrand the exteriors. We will renovate the interiors to our full platinum level scope, which increases the value of the asset to get that profit margin for the investor. If you'd like to learn about how you can partner with us on these exciting opportunities, and go to our website and set up a call with our team.
So I know that you got in the space similar to me in the fact that you kind of started as an LP investor. Even before that, of course, you were involved on the single family, home ownership side, as was I. So really our journey into the space is very similar, sans the fact that I never owned an ATM machine company, right? But that said, you got in on the active side, you transitioned, from there into syndications, you got started as a limited partner, passive investor. So all of that really prepared you, and maybe I'm saying this correctly or not, that really prepared you to then be in a position where you could speak from an authority perspective. You could educate others, on the benefits that you were personally receiving, as a passive investor. So that's really where Pacific Capital was originated from. Am I saying that right?
You are saying that 100% correct. I never wanted to bring anything to somebody that I didn't understand, that I wasn't doing, and that I hadn't already done before. So the reason, I stress that to everybody. If you want to be a general partner, that's great, but you should probably get some limited partner experience and understand how the deals work, not just from raising the capital, but from operating the business, dealing with the lenders, dealing with the insurance people, dealing with the property management companies. You should figure that part out before you come forward or raise your hand and lean in and say, I would like to be in charge of this asset. You want to have some experience under your belt. And that way, when you go out to your investor group, you can say, this is what I've done, this is where I've gone, and this is what I'm bringing to you.
Yeah. And what would you say is probably the most important, metrics that investors should look at before deciding to deploy their capital into a passive real estate investment?
I think number one is you better work with a team that understands how to operate that deal effectively, efficiently, and that this isn't their first. Everybody's going to have their first, but with me on my first, I went with a team that already had 4 or 5 assets under their belt and that they have done this before. So even though it was my first, it was not theirs. And I wanted to make sure that I was on a team that had the experience I didn't have. So then they could watch the blind spots I probably would never see.
Yeah, no, that makes total sense. And obviously the team is incredibly important, and I know that, there's all kinds of different grades that we could give to a operating team, right? And I can't stress this enough with investors that you're not investing in the pitch deck. You're not even investing in the property, really. You're investing in what I call execution risk. You're investing in that operator's ability to execute on whatever the set or spoken business plan is, right? And guys like you and me that have been involved in passive real estate investments as LP investors with multiple different sponsors, different asset classes, we have our ears, to the street to know what's happening in the space. There's a lot of value in that, right? That the non-savvy, non-sophisticated investor really just isn't going to have access to. So do you have a particular, criteria that you use, when assigning a sponsor as an A class syndication team versus a B class, C class, et cetera?
Absolutely. And it's funny you asked the question that way. I'm on a number of different teams, and some of them I call weekend warriors. They still have their full-time W-2, and I'm on a team with them, and some of them are like, I don't know, I don't know what to do. But so for me, in my on my go forward future, I'm only going to work with experienced teams that are laser focused and they're working on one asset class and they have one focus. I'm not pivoting to storage. I'm not pivoting to mobile home parks. I'm not pivoting to other stuff. I'm staying in this space. I am staying laser focused on multifamily with a team that has a track record, has the backing and the depth to weather the storms we've been through. And speaking of, I'm just going to say, look at Rise, 57 assets in 6 years. Well, this is the beginning of year 6, so 5 full years. Not one capital call through this horse manure we've been through with the interest rate market and the insurance markets over the last 2.5, 3 years, and not one capital call. And they're still distributing cash on over 80% of their assets. They're fixing the other couple right now, according to Zach, so they could start redistributing cash on those because of the loans. But they had the depth and the backing to make that happen. So for me, staying laser focused with people that are laser focused on what they're doing is super important for me. And I think it's going to be super important for my investors, and they're going to understand that the more we dig in.
Yeah, no, and I appreciate you calling out the weekend warriors. I'm going to steal that from you because that's so true. You've got teams out there that are syndicating, anything from apartment buildings to self-storage to assisted living to flex office, retail, industrial, et cetera. And some of them are honestly 2 men in a truck, right? Where there's others, are, teams of 2, 3, 4, 500, people, and they're vertically integrated. So really, what gives me a lot of confidence in partnering with operators that aren't, distracted by the new shiny asset class that exists out there is really those operators that are, vertically integrated and really can control, all stages of that, business plan timeline from acquisition all the way through disposition. And for what that does for me is it gives me confidence as an investor that sponsor is, de-risking that opportunity, and they're increasing that likelihood of a predictable outcome. Does that make sense?
I couldn't have said it better. And the de-risking and the vertically integrated, because they can control all costs A to Z. Like I'm on a team, and we were doing some upgrades on this. We have 254 unit deal, and we're doing the upgrades. And I literally said, I raised most of the capital on it, and I sat in on a property management meeting. I go, oh my God, we've already completed 60 of these upgrades, and I just unmiked myself on the meeting, and I said, how much more rent are we getting from doing these upgrades? And they're like, we're not. Our rents are flat. And I go, maybe it's time to stop. I go, we thought they were going to cost $8,000. They're now costing $14,000 to do the upgrade, and we're not getting any additional income. So we're not helping the investors. We're sort of helping the complex, but we're not helping our investors, and we're not keeping our cash in hand where it's safe, where if we have a turbulent times, we have that backing. And my partner said, no problem, we'll stop. Well, I tuned into the meeting 2 weeks later, and the property manager's like, we just took another 10 units offline to do the upgrades, da, da, da. And I go, I unmiked and I said, I thought we had a conversation around this and we weren't going to do that. No, you said we shouldn't do it. I hadn't made that decision. And I go, not a problem, we'll have a vote tonight. I go, so I put a text string together between me and the other partner and the gentleman that was our asset manager. He actually happened to own the construction company also. So he had a other benefit from doing the upgrades where we didn't. And we had a little vote and we stopped them immediately, because if we're not getting a benefit and we can't control the cost because we're outside of our bounds already, we're not doing our investors or our tenants or our own business any benefit from that.
Yeah, it makes total sense. I mean, if you're not able to capture the rents, if you're not able to push the rents, through your renovation, strategy and plans, then you're not forcing NOI growth. And if you're not forcing NOI growth, you're not increasing the likelihood of that predictable outcome that I talked about earlier. So I think that was a good pivot. I know, Michael, that your portfolio also includes triple net properties. What role does the triple net investment strategy play in your overall, investment strategy? And how do you, balance those types of investments, with those that you're making in multifamily?
For me, during COVID and all the interest rates and everything were going a little crazy over the last couple of years, we decided to partner with a couple other people, and we just went in and bought triple nets for cash. Like the little Starbucks right over here, we bought one of those for $2.1 million in Coventry, Nebraska. It's paying us about a 6% return. I was getting about 5% at Chase. So putting cash into this and getting a 6% return, it's like a bank account, literally. And we have another one that's paying about 8%, but we paid 100% cash for these assets. The tenant covers the insurance, everything that has to do with it. And we just get a straight cash return. So for us, it was just about parking money into an asset that is already paying better returns than what I could get at the banking system, although my money's tied up in the banking system. But there's an appreciable asset on the other end of that. And when you get rents that are going up 10% every 5 years, it's not a bad way to set your money aside for 5 years, watch it grow, and then check out what your exit strategy could be at that time, because maybe lending turns around over the next 2.5 years. And then when it's time for us to look at selling those assets. So for me, it was just a place to park capital outside of the banking system and have a little bit of diversification and see how other real estate performs in the commercial sector.
Yeah, I think it's great. I mean, diversification is obviously, prudent. I personally preach diversification. I certainly know that, those that are connected and affiliated with Wall Street, are doing the same thing, right? So I appreciate your perspective, there. And I'd love to also, hear your perspective on kind of where we're at right now, in the current, economic cycle in the commercial real estate space. I know that you don't have a crystal ball, and neither do I, but you and I have both kind of lived through, the peaks and the valleys, in the space, right? So where do you think we are at this point in time, and kind of the early part of 2025? And, what do you see for the balance of this year and going forward?
Well, I do have a crystal ball. Side note. Where do I think we are? So if we look at a clock, I think we're and midnight or 12 o'clock being the peak of a market and 6 o'clock being the valley. I think we're between 7 and 8. I think we've hit the bottom, because the amount of transactions I'm seeing come across my desk that I say no to on a regular basis, and I say no to a lot more deals than I say yes to go out and work with. I think we're between 7 and 8. I think we're starting to come out. Interest rates over the last 100 days have dropped a full point per the Fed. Even though they went down, treasuries went up. So interest rates for us in this space haven't really moved much in the right direction. But I think we're between 7 and 8 o'clock. And I think we're, with the new administration coming in, we're going to see, because he's a real estate guy, we're going to see some push towards 100% bonus depreciation. I think we're going to go back to the Tax and Jobs Acts of 2017, and bonus depreciation is going to come back 100%. Probably, I'm not saying Q1, but maybe by the end of the year, we'll have that back in place. And I've heard rumors from folks that had the president's ear that it might even become permanent. So as a real estate guy, and if we think back to that run with that administration, that's the last time interest rates were at what number? 0. So we were borrowing money at 2 and 3% because of the spreads the banks put on it. But the last time we were at 0 was the last time was when Trump was in. And as a real estate and a growth guy and an economy driver, he's going to push and lean real hard on getting those things down, I believe, personally. And I'm not a CPA economist or anything of that nature, but this is just my personal belief. I think interest rates over the next year are going to come down even more than they did in the last 100 days. And we're going to see a lot more transactions and movement, because that's what makes the world go round, is it making money move. When money's stagnant, none of us are doing well. So I think with Trump coming into office, we're going to see a lot more movement in the real estate space.
Yeah, no, I appreciate your perspective on that. And for those that are listening to this episode, Michael does in fact have a crystal ball, and he showed it on video. So uh, I think your perspective is really spot on. I mean, in my own kind of personal, assessment of where we're at, we're really at the back end of purging through all of the variable interest rate loans, the bridge loans, on deals that were acquired in 2021 and 2022. We're largely moving our way through those now, and it's really at that midway point of 2025 where the lion's share of those bridge loans, unless they were there was a refinance event involved, or unless there was some kind of a restructuring of that debt, those loans came due, and they're really heavily distressed, financially distressed opportunities, will have largely, moved their way through the system. But, that coupled with the fact that we're in a stabilizing interest rate environment, I wouldn't necessarily say we're coming down, at least as it relates to, where the market prices interest rates at. But certainly feels like we're in kind of that stabilizing, stage. And then, of course, we know that new supply, especially in the multifamily space, is scheduled to fall off a cliff, as we move through the next 12 to 18 months. And usually when that happens, you have high absorption rates of whatever new supply that there is, of course, and then obviously that has a tendency to impact valuations as well. I would like to ask you, kind of this question, speaking specifically to that, we'll call it the newbie investor. Okay. What advice would you offer to somebody that's just now starting out or wants to start out in real estate investing, and especially those that are considering making an investment in multifamily?
Number one, find a team that you can get on the phone, you can get on a Zoom call, and that you feel comfortable with, and have open dialogue conversations around that, and make sure that you're comfortable with who you're working with. Most investors, me included, I work with people I know, like, and trust, and then the deal comes second. If I don't know you, like you, or trust you, you could have the best deal on the planet, and I'm probably not going to give you my money, because I want to make sure that I can pick up the phone, have a conversation with a Jeremy or a Zach or whomever I'm working with. Like, I can't call Grant Cardone, so I'm not putting money in his 3% fund. But I want to work with people I can actually reach out and touch. And it's nice that your guys' office is literally 6 minutes from my home, so that gave me more comfortability on working with you guys. And I just you have to be able to trust who you're giving your money to. I literally got a mailer for a free steak dinner in 2 weeks. And at the bottom, it's a disclaimer: we will be talking about investing in real estate. And I'm like, that'd be a great place for me to go, because it's always good for me to be in the room with other people that are looking to place money. But you have to, I don't know this guy from anybody. He could have the best product in the world, but until I get to know him, I'm not going to let money out of my bank account go. And I'm not going to send it to go to work with people I don't know and like and trust.
Yeah, absolutely. And it makes total sense to me. I'm really, you're leveraging somebody else's, time, experience, network, that their track record, et cetera. But you're exactly right. I mean, those people that are brand new investors, they need to get educated. They need to surround themselves from a networking perspective, to be in the room with the right types of people. And then really at the end of the day, they need to get over their analysis paralysis and just get started. I always tell people that's really how I learned what I learned in the real estate space, is by deploying your own capital, right? When you start deploying your own capital into opportunities, you have a tendency to want and desire to learn more, right? But the only way that I was able to get to that point is, by getting started and really learning my way through the process. Last kind of question for you, Michael, is what's next for Michael Guthrie and Pacific Capital? Do you have any specific, goals or bucket list items that you'd like to check off as we finish up 25 and beyond?
That's that's probably the $1 million question. I wanted to back up just to what you were talking about. A year from now, if you're not investing, you're going to wish you had started today, because when you start to see the assets that are being acquired today go to market and sell in 2, maybe 3 years from now, because I do believe we're at the bottom of a market, and anybody that's getting in today is going to really reap those benefits 2, 3, 4, 5 years from now in a major way. You're going to be looking back going, why didn't I put more money in? I get asked all the time, well, how much should I put in? I go, I'm not going to tell you how much to put in. My job is to make you regret you didn't put more in later. So what's next for me? Continuing to just nurture, network, and consult with people and help and give back. And so I do some coaching in the space, but for me, it's a give back. And I want to make sure that I'm here to help others understand what they're getting into, whether it's with me or whether it's with somebody else. We all need to be investing our dollars because we worked so hard. Now we need the money to work as hard as we've worked so it can continue to grow and take you or me, the investor, to the place we want to be. I'm 57. I really don't work. I like doing what I'm doing here. I raise capital when I want to raise. I do things I want to do. I got a grandson on the way. So for me, taking care of the grandson, spoiling him, enjoying my time with my wife because we worked so hard for so long. It's just about, we work so hard for the freedom as an entrepreneur. We become an entrepreneur because we want freedom of time. And all that did when I became an entrepreneur is my time was taken up by every single person I sold an ATM to because they had my cell phone and they could call me at any point in time. So now not only being my own boss, everybody that I was working for was my boss.
Yeah, it makes total sense. So speaking of giving back, what would be maybe 1 or 2 different ways that our listening audience can connect with you to learn more about what you're up to?
You can always connect with me on my website at pacificcapitalllc.com. I also, every podcast I'm on, when they ask this question and everybody asks it, I give out my cell phone number, not my system, but I'll give out, you can text me if you'd like to connect, and let's connect. My cell phone's 509-270-6701. That will actually go right here to my phone. I gave it out last night to a guy and he goes, will that go to your networking system or is that going to go? No, it actually goes right to my cell phone. Because if you want to connect with me, I want you to be able to get me and I want to be able to help you. So I'm here to help. I'm here to educate. And if there's anything I can ever do for any of you, I'm happy to help.
Yeah, I appreciate that. And it's such a relationship business. It's a team sport business. So I really appreciate you, providing your cell phone number to our listening audience. We'll put that as well as your website in the show notes for the episode. And Michael, really appreciate the value that you brought us today.
Absolutely. I enjoy this. This is fun for me.
Good. Well, thank you. And thank you, listening audience, for jumping into another episode of The Freedom Point. We look forward to having you join us on the next episode.
Thank you for hanging out with us today and for listening to the Freedom Point podcast, powered by Starting Point Capital. This show is for entertainment purposes only. Nothing said on this show should be considered financial advice. Before making any financial decision, please consult with a professional. This show is copyrighted by the Freedom Point podcast. Written permissions must be granted before syndication or rebroadcasting. If you're interested in connecting, you can find contact information at startingpointcapital.com.